Today, Bank of America dropped a number that should make you pause. $309 for silver. Not 30, not 50, 309. Let that settle for a moment. Because when a major institution places a figure like that on the table, it is not random, it is not emotional, it is built on models, projections, assumptions about supply, demand, monetary conditions, and global stability. But here is what should concern you far more than the number itself. The assumptions underneath it may already be outdated. And if those assumptions fail, $309 may not look extreme. It may look restrained. We are not talking about a small cyclical bounce in a commodity. We are talking about a structural repricing scenario. And to understand whether 309 is fantasy or foundation, you have to step outside the spreadsheet and look at what is actually unfolding around the world. Because while analysts debate price targets, energy corridors are destabilizing, supply chains are fracturing, currencies are weakening, and geopolitical alignments are shifting in ways that most investors are not fully processing. Before I go deeper, let me make something absolutely clear. I do not sell courses, I do not sell signals, I do not offer mentorships, memberships, or private trading groups. If anyone contacts you claiming to represent me in that way, it is not legitimate. I am here for one reason only: to analyze what is happening, connect the macro forces, and present both sides so you can think independently. No fear tactics, no hype, no blind optimism, just data and structure. Now let's address the core of this. Bank of America's $309 target is based on structural supply deficits in silver, expanding industrial demand, and a macro backdrop that increasingly favors hard assets. Those factors alone are significant. Silver demand from solar infrastructure, electronics, electric vehicles, and medical technologies continues to expand at a pace that mining supply has struggled to match, and silver supply is not something that can simply be switched on at will. Most silver is produced as a byproduct of copper, zinc, and lead mining. That makes production relatively inelastic. Even if prices rise, new primary supply does not flood the market quickly. But the industrial demand story is only part of it. What elevates this conversation to another level is the macro environment forming around it. Today, the world is constructing what can only be described as an inflation engine, not by accident, by structure. When energy choke points become unstable, inflation does not stay regional. It spreads mechanically through every economy connected to that energy flow. Oil is not just a fuel, it is the base layer input for transportation, agriculture, manufacturing, aviation, plastics, chemicals, and global logistics. When risk premiums rise around energy transit routes, the cost structure of everything shifts upward. Consider the Strait of Hormuz. Roughly 20% of the world's oil supply moves through that narrow passage. That is not a marginal statistic. That is systemic exposure. Even the credible threat of disruption increases insurance premiums, alters shipping routes, and tightens supply availability. You do not need sustained physical damage to create inflation. You only need elevated risk that forces markets to price uncertainty, and uncertainty is expensive. Then layer in the Red Sea dimension. Shipping disruptions have already caused rerouting, extended delivery timelines, and multiplied freight costs. Insurance premiums have surged. Transit times that once measured in weeks are stretching significantly longer. These costs are not absorbed quietly. They are passed through supply chains. Businesses pass them to consumers. Consumers reduce discretionary spending. Corporate margins compress. Equity markets wobble. Retirement accounts feel pressure. That is the feedback loop. Now step back and recognize what this means. When households allocate more income toward energy and food, savings decline. When corporate earnings face pressure from higher input costs, valuations adjust. When credit risk premiums rise, financing tightens. The illusion that global power projection comes without domestic economic consequences fades quickly. Inflation hits daily life, while asset volatility challenges long-term wealth building. That dual pressure creates demand for stability, and this is where silver and gold become relevant beyond speculation. Hard assets exist outside the digital financial system. They do not require counterparty trust. They cannot be printed into existence. They cannot be frozen with a keystroke. In times when monetary policy loosens and geopolitical risk rises simultaneously, historically, precious metals gain structural support. Now ask yourself this: does $309 fully reflect what happens if energy corridors remain unstable for years rather than months? Does it reflect what happens if inflation proves persistent rather than temporary? Does it incorporate what occurs if countries observing sanctions and asset seizures accelerate efforts to reduce dependence on dollar-denominated reserves? De-dollarization is no longer theoretical discussion. It is active policy among several major economies. When reserve diversification accelerates, demand for tangible stores of value rises. Monetary policy adds another layer. Rate cuts have occurred, and expectations of further easing remain embedded in markets. A weaker dollar typically supports precious metals. Real interest rates, defined as nominal yields minus inflation, are critical. If inflation remains elevated while nominal rates decline, real yields compress. That environment historically benefits gold and silver, and if inflation becomes entrenched due to structural supply instability, real rates may remain under pressure longer than traditional cycles suggest. At the same time, physical demand for silver has remained resilient. Dealers have reported tighter inventory. Premiums over spot prices have stayed elevated in many regions. That divergence between paper pricing and physical acquisition cost suggests that underlying demand is stronger than futures markets alone imply. Structural deficits, according to industry data, are not easily resolved. And when deficits persist year after year, pressure builds. Now consider psychology, markets price expectations. If investors begin to recognize that the global financial system is undergoing restructuring, portfolio allocations shift. The post-Cold War order is fragmenting. Supply chains are being reshored or realigned. Energy security has returned to the center of national policy discussions. Nations are reassessing reserve compositions. These are not minor adjustments. They represent structural transformation. $309 may sound dramatic compared to current price levels, but dramatic compared to what baseline? If the world continues along its present trajectory, where geopolitical stress intersects with monetary expansion and structural supply deficits, revaluation becomes plausible rather than extreme. That does not mean the path will be linear. Volatility is inevitable. Precious metals can experience pullbacks, especially during short-term dollar strength or risk-on equity rallies. But structural narratives operate over longer horizons. The key is not blind belief in a specific target. Forecasts are almost always imperfect. The key is understanding direction. When multiple macro tailwinds align, energy instability, inflation persistence, monetary easing, supply deficits, de-dollarization, the probability distribution shifts. Today, the weight of evidence suggests that silver is positioned within a broader macro shift, rather than an isolated commodity rally. Whether 309 proves conservative or optimistic will depend on how these structural forces evolve. But dismissing it outright without examining the underlying mechanics would be short-sighted. Because when energy flows become leverage points, when currencies weaken under debt burdens, when geopolitical alignments fracture, and when physical supply remains constrained, markets do not respond gently. They reprice. And sometimes they reprice far beyond what once seemed reasonable. That is the context in which 309 must be evaluated, not as a sensational headline, but as a scenario embedded within a changing global order. Part 1 complete. Word count 1,500. Part 2, 1,500 words. Now that we've laid the foundation, we need to examine the pressure points more closely because price targets do not exist in isolation. They exist within systems, and the system today is under visible strain. When we talk about $309 for silver, we are not simply talking about enthusiasm for a commodity. We are talking about a chain reaction that begins with energy, flows through inflation, moves into currency markets, and ultimately reshapes investor behavior. Start with the inflation engine itself. Inflation is not always caused by excessive consumer demand. Sometimes it is created by structural supply stress. When the arteries that move oil, gas, and goods become unstable, the costs ripple outward. The Strait of Hormuz remains one of the most sensitive transit routes in the world. Even elevated risk, without sustained disruption, increases insurance premiums and forces precautionary measures. Tankers reroute. Shipping times expand. Buyers compete for secure supply. The pricing of crude shifts upward not because demand exploded, but because risk entered the equation. And oil is not just fuel for vehicles, it is the backbone of industrial civilization. Diesel powers trucking networks, jet fuel moves global trade, fertilizers depend on energy inputs. Plastics and packaging originate from petroleum derivatives. Every increase in energy cost multiplies across industries. Businesses face higher operating expenses. Those costs are passed along. Consumers feel it in food prices, transport costs, and daily necessities. Inflation becomes embedded not because central banks desired it, but because structural fragility made it unavoidable. The Red Sea adds another layer to this dynamic. Shipping reroutes around conflict zones extend delivery timelines and significantly increase freight expenses. What once moved efficiently now travels through longer, more expensive paths. Insurance markets adjust pricing based on threat perception. Companies hedge exposure. All of it translates into higher final prices, and when essential goods cost more, households adjust behavior. Discretionary spending contracts. Savings rates fall. Debt burdens feel heavier. Financial markets respond quickly to these pressures. Equity valuations depend on stable margins and predictable cash flows. When input costs rise and consumer demand softens, earnings expectations adjust downward. Investors demand higher risk premiums. Credit markets tighten. Corporate borrowing costs increase. That tightening further slows expansion. It becomes a feedback loop. Inflation compresses purchasing power while asset volatility erodes confidence. Now place monetary policy into this context. Central banks are navigating a narrow path. If they tighten aggressively to suppress inflation, they risk destabilizing debt-laden economies. If they ease too quickly, they risk reigniting inflationary momentum. Today, the environment leans toward accommodation. Rate cuts have occurred, and markets anticipate further easing if economic growth weakens. Lower nominal rates combined with sticky inflation create falling real yields. Historically, that has been supportive for precious metals. But it is not only about rates. It is about currency perception. The dollar remains dominant in global trade, yet its dominance is increasingly questioned. Sanctions, asset freezes, and financial weaponization have encouraged several nations to explore alternative settlement mechanisms. De-dollarization is gradual, but momentum matters. When reserve managers diversify even incrementally, demand for tangible assets rises. Gold has already seen substantial central bank accumulation. Silver often follows broader precious metal trends when investor interest expands beyond gold. Now let's examine silver specifically within this macro framework. Industrial demand remains strong, particularly from solar technology. Silver's conductive properties make it critical for photovoltaic production. The global push toward renewable energy increases baseline demand. Electronics manufacturing continues expanding. Electric vehicles require substantial silver usage relative to traditional vehicles. Medical applications rely on its antibacterial properties. These are structural demand drivers, not speculative bubbles. Supply, however, has not expanded proportionally. Mining output faces geological, regulatory, and capital constraints. Because silver is primarily a byproduct, production depends on broader base metal mining decisions. Even if silver prices rise sharply, it does not automatically unlock rapid new supply. That imbalance between structural demand growth and constrained production forms the backbone of the bullish thesis. Add to that the persistent gap between paper pricing and physical premiums. Retail buyers in multiple regions have paid elevated premiums over spot prices, indicating strong underlying demand for physical metal. When futures markets trade lower, but physical inventory remains tight, it signals tension beneath the surface. That tension does not resolve quietly if deficits continue. However, it is essential to acknowledge the opposing case. Precious metals do not rise in straight lines. If geopolitical tensions de-escalate meaningfully, risk premiums embedded in energy prices could fall, shipping routes could normalize, freight costs could decline, inflationary pressure might ease faster than expected. In that environment, safe haven demand for gold and silver could diminish temporarily. A strengthening dollar would create additional headwinds. If economic growth surprises to the upside, central banks might pause easing cycles, supporting currency strength and pressuring metals. There is also the possibility of a liquidity shock. In severe equity corrections, investors sometimes sell everything to meet margin calls. History has shown that during initial crisis phases, even gold and silver can experience sharp declines as liquidity is sought urgently. It happened during past financial crises. Phase 1 can look chaotic before Phase 2 reasserts the safe haven bid. That is why positioning and time horizon matter. A structural thesis does not eliminate short-term volatility. It requires patience and disciplined allocation. Being correct directionally but over-leveraged can still result in losses. Markets punish excess leverage without mercy. Returning to the $309 projection, consider what it implies. It implies a significant repricing relative to current levels. For that to occur, multiple tailwinds must align. Persistent deficits, continued industrial growth, sustained or rising inflation, monetary accommodation, ongoing geopolitical stress, and perhaps an acceleration in reserve diversification trends. None of these are guaranteed individually, but collectively, they are not improbable. The broader context is what makes the number plausible rather than sensational. We are living through a period of structural transition. The financial architecture established decades ago is adapting under pressure. Debt levels across developed economies remain elevated. Financing those obligations often requires monetary flexibility. Monetary flexibility frequently dilutes purchasing power over time. Hard assets historically serve as hedges against that dilution. Silver occupies a unique position because it straddles both industrial and monetary demand. It is not purely a monetary metal like gold, nor purely industrial. That dual identity amplifies its responsiveness to macro shifts. When industrial growth remains intact and monetary conditions loosen simultaneously, silver can outperform expectations. But again, none of this eliminates risk. Markets oscillate between optimism and fear. Short-term price movements can contradict long-term narratives. That is why analysis must remain balanced. The bullish case rests on structural forces that appear durable. The bearish case rests on potential de-escalation and stronger currency dynamics. Investors must prepare for both. $309 does not represent certainty. It represents a scenario. And scenarios gain credibility when macro forces converge. Today, energy instability, inflation persistence, constrained supply, accommodative monetary policy, and geopolitical realignment are not isolated events. They intersect, and when intersections occur in macroeconomics, repricing events often follow. The question is not whether volatility will occur. It will. The question is whether the structural floor under precious metals is rising quietly beneath that volatility. If it is, then temporary pullbacks become noise within a broader revaluation cycle. This is not about blind optimism. It is about recognizing patterns that have repeated throughout financial history. When currencies face structural pressure, when supply chains fracture, when geopolitical confidence declines, tangible assets regain relevance, sometimes gradually, sometimes suddenly. $309 sounds extraordinary only within the stability of the past. In an environment defined by transition, extraordinary numbers become less extraordinary. Now we arrive at the most important question, not whether $309 is possible, not whether silver can rally sharply in a volatile environment. The real question is, what kind of world produces that outcome? Because price is a symptom. The underlying structure is the cause. And today, the structure of the global financial system is under visible pressure. We are living through a period where multiple long-standing assumptions are being tested at the same time. For decades, markets operated under the belief that globalization would expand uninterrupted, that energy flows would remain secure, that reserve currencies would remain unquestioned, and that monetary authorities could fine-tune economic cycles without structural damage. That confidence shaped portfolio allocations, trade relationships, and risk models. But confidence is not permanent. It erodes when repeated shocks expose fragility. Consider debt. Developed economies carry historically elevated debt levels relative to GDP. Servicing that debt becomes increasingly complex when growth slows or interest expenses rise. Policymakers face a difficult balance. Tighten too much in growth contracts, ease too much and inflation accelerates. In such an environment, monetary expansion often becomes the path of least resistance. Over time, that expansion dilutes purchasing power. It may happen gradually, almost invisibly, but its cumulative effect is significant. Now combine debt pressure with geopolitical fragmentation. The post-Cold War order created a relatively predictable security framework. Today, alliances are shifting. Trade blocs are redefining themselves. Sanctions have become common policy tools. When countries observe foreign reserves frozen or financial systems weaponized, they adapt, they diversify, they reduce concentration risk. Reserve diversification does not happen overnight, but it does not need to be immediate to matter. Even marginal shifts in global reserve allocation can move markets. Gold has already benefited from increased central bank accumulation. Silver often follows when broader investor participation expands. Unlike gold, silver's market is smaller, which means capital inflows can have outsized price impact. That dynamic amplifies both upside and downside moves. It is part of silver's historical volatility profile. Energy insecurity adds another layer. When energy corridors become leverage points in geopolitical disputes, price stability becomes harder to maintain. Even if full-scale disruption is avoided, persistent risk premiums can embed higher baseline costs into the global economy. Those higher costs influence everything from manufacturing margins to food production. If inflation becomes structurally elevated rather than temporarily cyclical, asset allocation strategies adjust. Investors seek hedges not just for months, but for years. Now let's examine the behavioral dimension. Markets are driven by expectations. When enough participants begin to believe that structural inflation risk exists, they position accordingly. That positioning reinforces price movement. As prices rise, momentum traders enter. As momentum builds, media coverage expands. As coverage expands, retail participation increases. This is how repricing cycles accelerate. It is not purely about fundamentals at that point. It becomes about perception aligning with structure. But perception can also reverse quickly. If geopolitical tensions ease materially, if shipping routes normalize, if energy prices stabilize, if inflation declines faster than anticipated, the urgency behind hard asset accumulation may fade. That is the opposing path. A stronger dollar would likely pressure metals. Higher real interest rates would create additional headwinds. Investors must acknowledge this possibility. Markets are rarely one-directional. This is why planning matters more than prediction. A structural thesis does not eliminate volatility. It requires clarity of time horizon. Are you evaluating silver as a multi-year hedge against currency debasement and geopolitical instability? Or are you attempting to trade weekly price fluctuations? Those approaches require different strategies and different tolerance for drawdowns. Confusing them can lead to costly mistakes. Risk management is not optional in environments like this. Over-leveraged positions can be liquidated even if the broader thesis proves correct. Liquidity events force indiscriminate selling. History has shown that during acute financial stress, correlations temporarily move toward one. Assets fall together before separating again. Understanding that pattern prevents emotional reactions during turbulence. Now return to the number itself, $309. It represents a substantial move from current levels. For that scenario to unfold, several forces must remain aligned. Structural deficits must persist. Industrial demand must continue expanding. Monetary policy must remain accommodative relative to inflation. Energy instability must maintain risk premiums. And reserve diversification trends must not reverse. None of these are guaranteed, but none are implausible either. The broader transformation underway suggests that we are not in a typical commodity cycle. We are navigating systemic adjustment. Supply chains are being restructured for resilience rather than efficiency. Energy strategies are being rewritten for security rather than cost optimization. Financial alliances are shifting. These transitions create friction. Friction creates volatility. Volatility creates repricing opportunities. Silver's unique dual role, as both industrial input and monetary metal positions, is at the center of this transition. When economic activity expands through renewable infrastructure and technology adoption, industrial demand rises. When monetary confidence declines or inflation accelerates, investment demand rises. Few assets sit at that intersection, but discipline remains critical. Emotional decision-making in volatile periods can undermine even well-researched positions. A clear plan for multiple scenarios reduces reactionary behavior. What happens if silver corrects sharply before rising? What happens if it rallies faster than anticipated? What allocation fits within a diversified portfolio? These are strategic questions, not emotional ones. The coming months will provide signals. Watch energy markets carefully. Spikes tied to transit risk would reinforce the inflation thesis. Monitor currency strength, particularly the dollar. Persistent weakness would support metals. Observe real interest rates. Falling real yields historically favor precious metals. Track physical premiums relative to futures pricing. Widening gaps can indicate underlying demand strength. Follow central bank reserve reports for continued accumulation trends. And pay attention to geopolitical developments affecting shipping and infrastructure. Each of these factors contributes to probability weighting. None alone determines outcome. Together, they shape the macro landscape. It is also important to avoid fixation on a single target. Forecasts are inherently imprecise. $309 could prove too high. It could prove too low. It could take longer than expected. What matters is whether the structural reasoning remains intact. If the underlying forces persist, price will adjust over time. Markets eventually reflect reality, though timing is unpredictable. We are witnessing a period where the margin for error in policy is narrow. Debt burdens are elevated. Inflation remains sensitive to supply shocks. Geopolitical tensions intersect with energy dependencies. Financial markets are interconnected in ways that amplify stress quickly. In such environments, assets outside the credit-based system often attract renewed interest. Silver has endured cycles of neglect and enthusiasm throughout history. What differentiates the current moment is the convergence of structural drivers, not one catalyst, but several operating simultaneously. That convergence is what gives the $309 projection weight. Still, caution is warranted. No asset is immune to volatility. No thesis is immune to new information. Continuous evaluation is essential. Flexibility does not mean abandoning conviction. It means adjusting when data changes. Today, the weight of evidence suggests that hard assets deserve serious consideration within a thoughtful wealth preservation strategy, not as speculation, not as blind faith, but as recognition that systemic transitions often elevate tangible value stores. $309 is not merely a headline, it is a reflection of what the world might look like if current trajectories continue. Whether that trajectory accelerates or stabilizes remains to be seen, but ignoring the structural shifts unfolding would be unwise. Preparation rewards patience. Impulse punishes it. Analyze the data. Understand the risks. Define your time frame and remain adaptable. Because when systems change, prices follow. So now we step back and look at the bigger picture because $309 for silver is not really about a price prediction. It is about systemic pressure. It is about the environment that makes that kind of repricing possible. And today, that environment is not stable. It is not predictable. It is shifting in ways that go far beyond a single commodity chart. For decades, global markets operated under a set of assumptions that felt permanent. Energy would flow without disruption. Globalization would expand efficiency. The dollar would remain unquestioned as the dominant reserve currency. Monetary authorities would smooth out recessions with controlled adjustments. Debt would grow, but growth would outpace it. That framework supported equity expansion, suppressed volatility, and kept inflation relatively contained. But structural stability is not a law of nature, it is a condition, and conditions change. The world now is defined by fragmentation rather than consolidation. Trade alliances are being reassessed. Supply chains are being reshaped. Energy security has become a strategic priority instead of a background assumption. When energy becomes a geopolitical tool rather than a neutral commodity, inflation risk changes character. It stops being cyclical and starts becoming structural. Risk premiums embed themselves in baseline pricing. Insurance costs rise. Shipping routes adjust. The cost of stability increases. That structural pressure feeds directly into currency dynamics. High sovereign debt levels require flexibility. Governments facing fiscal strain cannot tolerate permanently elevated borrowing costs. Central banks must navigate between controlling inflation and maintaining financial stability. If growth weakens while debt burdens remain high, policy often leans toward accommodation. Accommodation, over time, dilutes purchasing power. It may not feel dramatic in a single quarter, but compounded over years, the effect is significant. This is why tangible assets re-enter the conversation during systemic transitions, not because they are magical, not because they eliminate volatility, but because they sit outside the credit-based financial structure. Gold has historically been the primary monetary hedge. Silver occupies a unique position because it bridges monetary and industrial demand simultaneously. That dual identity becomes important in periods where economic transformation and monetary uncertainty overlap. Think about renewable energy expansion. Solar infrastructure requires silver for conductivity. Electrification trends increase baseline industrial usage. Medical technologies rely on its antibacterial properties. Electronics manufacturing continues growing globally. These are not temporary demand spikes driven by speculation. They are embedded within technological progress. At the same time, silver supply remains constrained by the reality that it is largely a byproduct of other mining operations. Production cannot simply double because prices rise. Capital cycles, geological constraints, and regulatory timelines prevent rapid adjustment.